Hello, everyone, and welcome back to TradeFinder Live. It's great to be back with you all during this trading week. I'll be introducing Rob Roy here in just a few moments. We have lots of exciting topics to discover or to discuss on this session, rather, with the 2 days we've seen so far in this trading week. It's been rather nasty, although yesterday it seems to, or today seems to be rebounding from yesterday's sell-off. Rather, I'm interested to hear if Rob thinks that's the low or not. Sorry, first and foremost is our disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Well, as you can see, I was so excited, I jumped ahead and got ahead of the disclaimer. So without further ado, let's bring in the man of the hour and get to the topics of this week. Mr. Roy, how are we doing?
Good, Zach. How are you? Good afternoon, everybody. And for those of you that are alert subscribers at ewotrader.com, we talked yesterday during the Ewo Trader Live how we would have a lot to talk about during today's TradeFinder, and we certainly do with what went on yesterday. It was yesterday morning is when we do Ewo Trader Live, so that was pretty well timing with the morning sell-off. But I mentioned that where we close mattered. And then we would see how things were playing out today. So let's do that. Let's go ahead and take a look at the chart. And when we look at the chart, you can see that we had that big move down. I actually thought on Friday we might try to hold a little bit right in here in this area for some sort of a small little bounce moving into Monday, maybe the beginning of the week. We got a little bit of a reprieve. Come up and fill this one gap right here. But the market had other ideas. And for those of you that may not be aware, what really triggered this was a currency issue, and that had to do with the Japanese yen. And if you take a look at the chart of the yen, you can see that big spike up. That's the yen against the yen against the Aussie dollar, but the yen against the U.S. dollar pretty much looked the same thing. It was in general terms strength in the yen that created a discombobulation in the currency markets, and so that's what set the futures heading down significantly on Sunday night if you were watching it. And so that's what was the catalyst for this sell-off. So that occurred during Sunday night. Once the Asian markets opened, we had Japan moving down to a level that was comparable with Black Monday back in 1987, so pretty rough there. South Korea actually enacted their circuit breakers in the markets. If you're not familiar with what those are, following the big crash at 29 over the years, the exchanges enacted these things called circuit breakers so that we don't have that kind of a washout crash like we had in 29 ever again. If we start selling at a particular volatility speed, the market will actually slow down the process of orders so that you can't get as many sell orders off in time. And if that continues, then they literally shut the market down for an hour. They'll bring the market back up with the circuit breakers, and if the selling continues, they shut down for another hour. They bring it back up, same thing happens, they just close the market for the day. So all those are safeguards to stop what occurs, which is what happened yesterday, is that you get a big move down like this, margin calls go out, everybody has to sell to meet their margin calls, and everything just snowballs on top of itself, and you get one of these really extreme moves. So Zach's question was, is that it? Is that the bottom? Well, you can see for the short term, likely. We were way oversold on yesterday's open, and so we did get a little bit of a rebound back to the upside there that occurred throughout the trading day, and then we settled back down and finished right at the midpoint of the bar. We're getting a little bit of a bounce today. We're trading currently at the high of the day, as you can see, but I do want to encourage caution here. This is an oversold bounce, no doubt about it. But is it more than that? Not so sure. We definitely need to close this gap. We're getting close to that. I don't know that we close that gap at 540 right now. Perhaps that one stays a little bit longer. But we do need to close this gap from yesterday's open and then get closer to the 10-day moving average. I feel like, though, this is giving us a pretty good signal that that wave 5 up here is over. And when the wave 5 ends, you move back to the previous 4 if the wave 5 extended less than 100%. Just very general, basic Elliott wave rules. That brings us down to 500, which is a big round number. And I think that it's likely over the next few weeks, or at least before all this is really over, that we do make it down to 500. So I don't necessarily think that the selling is over yet. It could be, but these kind of flesh out moves, and we'll look at the volume. And you can see that question was actually asked during our EWO Trader Live, and the volume bar was up about where it was on Friday already in the first part of the day. And I said I would think that we would see a pretty big bar by the close, and we actually exceeded this one back here from April. So heavy volume selling, that does tend to give you a short-term washout. We're in the afternoon. We are getting a little bit of a bounce, but you can see that not a whole bunch of volume in here. So I would still be a bit cautious on where we are with the markets and the likelihood that we'll see 500 before things are over. We got to the point where we were getting calls for emergency Fed rate cuts, and the Fed fund futures then priced in 150 basis points of rate cuts by the January meeting. That was including January's meeting. Remember when we were talking about, is December going to be the only rate cut, and are we going to get one in September? And then it looked like the Fed was guiding towards September. Last Wednesday, the market liked that. That's where we were when we talked last Tuesday. All eyes were on the Fed meeting. So they did give well, Powell said that it's on the table. So he didn't really say we were going to cut rates in September, but that's as close as he can come without saying that we're going to. Market cheered that on Wednesday, and then it's been down ever since. So you can see the bounce up day that we had on Wednesday. We opened higher on Thursday, closed near the low, Friday bad, and then yesterday's short-term washout here in the market. So I know there's a lot of people that are out there picking and choosing particular stocks that got hammered pretty good yesterday, but this is a tradable bounce, but I don't think it's necessarily the fact that the bottom's in. We just haven't come down to that previous 4 yet, and I think that's likely. So taking advantage of short-term bounces, I think, is great right now, but just know that that's what they are. This doesn't necessarily mean the whole bottom's in and that we're ready to move back to the upside looking at the Fed rate cuts. Then we had the ISM services number that came in yesterday. That actually, believe it or not, was above 50. ISM services is the services sector, so restaurants, et cetera, hospitality jobs, that kind of stuff. And it said that the economy is still growing in that area. So a reading above 50 means growth or expansion. A reading below 50 means contraction and signs of a recession. But that kind of put an end to the bounce attempt that we had yesterday, feeling like, if the Fed's looking at that number, that's not going to prompt them for any sort of rate cuts. We even had Jeremy Siegel out there saying that the Fed needs to come in with an emergency 75 basis point cut now. And I think that would have spooked the market even more if the Fed would have done that, saying that what's so bad? Again, this was that currency trade, the overnight carry trade that they talk about a lot on the yen, which was the catalyst for this. But I don't think the market would have taken too kindly to an emergency 75 basis point rate cut. So we'll see if the Fed does step in before the September meeting now, but perhaps not. There's not a meeting in August, so that's why they kept calling for an emergency rate cut meeting. There were a lot of Fed governors out speaking yesterday, as you can imagine, and most of them were saying, yeah, we do need to cut rates, but no one was really sounding an alarm like, yeah, we're talking, we may do something, nothing like that. But multiple rate cuts priced in. And then after that ISM report came out, the original forecast was for 50 basis point rate cut. This is what the Fed fund futures had in September, another 50 basis points in the November meeting. and then 25 in December and 25 in January. So that's how they got to the 150 basis points. Well, then after that ISM report came in, the Fed Fund futures repriced, still 50 basis points in September, but they went down to 25 in November, and then 50 in December, and 25 in January. So still 150 basis points. They just rejiggered the order a little bit, if you will. So it does look like more rate cuts are coming, but that's because the economy is weakening. And remember when I was talking about the bond market, and we didn't want to see rates go down to that 161.8% level, because if we went down there, that meant that we were having a lot of negativity in the economy. But that's what we did. So we went all the way down, even lower on rates today, or yesterday, but bouncing back up a little bit today on rates. And I think that it bears looking at TLT. I know a lot of you ask about that in the U.S. market updates. So I thought I would just go ahead and show you that with what was going on in the bond market. And you can see now TLT is the 20-year, TNX is the 10-year. TNX shows rates, TLT shows prices. Prices and yields move in inverse proportions. So prices going up here on the TLT, and we got a little bit overbought here. And so we're coming back down a little bit today. And so I think that's warranted. I think we come back down a little bit more. So I do think we see a bit of a tick back up in rates and a tick back down in prices in the bond market, but not significantly so, just perhaps to fill these gaps because everything was so extreme yesterday. Almost a short trade here on TLT, but it's not a big move down. I actually thought about making that our case study consideration, but we're going to do something different today, which I'll show you in a minute. But that's what's going on. It was currencies, bonds, all that was creating the havoc that occurred in the equity markets yesterday. Well, obviously, we need to take a look at the VIX with something like this going on. And we had that big, huge spike. That was just before the market opened. The VIX spiked up to 65. Obviously, a very extreme move. We came back and we've been talking over the past couple of weeks, wondering if 17 and a half was going to be the new floor because we had broken above that level. And it seems like maybe that is the case, at least for the short term. So a little bit more volatility in the markets. That's fun if you trade options because you do get opportunities. But like I said, remember, these are shorter term trading opportunities. This is not sounding the all clear, I don't think, at least at this point in time. But that was a big, massive spike in the VIX. So that was also a signal that when we open, that was probably at least a short term bottom in the market, and then coming back down in the VIX today, back down towards that level. So pretty wild stuff yesterday to start the week. A little calmer today, but caution still is the key here. As I said, just don't necessarily feel like the bottom is in. So let's take a look at what happened with the rest of the markets here. We'll start with the dollar, and that took a big chunk out of the dollar. We had held so long there at 104, and we were wondering how we were still being able to hold that level. With the amount, at least I was surmising, how could we hold that level with the amount of debt that we have? But when rates go down, you feel like, okay, rates going down, it allows the U.S. government to continue to issue debt, and it costs less to service that debt. So that doesn't sound the alarm for the dollar with as far as the amount of debt. But when you start to get concerns about the economy and then all the currency crazy stuff that was going on the dollar yen, that is what broke the 104 level and sent us lower in the dollar. So all the craziness is over. Rick Santelli was on yesterday of CNBC. I mentioned his name because he's one of the few people that I turned the volume on CNBC to watch. I think he gives a lot of good information on the bond market. He talks every afternoon that we have a treasury auction, and he gives the results of the treasury auction, and oftentimes throws in a few pearls of wisdom. And he was talking about that carry trade, and he doesn't feel like that is necessarily over yet. And even though as extreme as it got Sunday night, it could still, at least in a smaller scale, happen again. That could be a little bit more of a catalyst to move us down to that 500 level on the SPY as well. So oversold bounce, maybe that continues into tomorrow. We'll see how far we get today, see if we get that gap closed today, close the gap with the 10-day moving average. And then it's when we find out where do we go from here, and if we're headed back down towards that previous 4. Looking at the Dow, the DIA, all these markets are going to look the same as you would imagine. Big moves down yesterday, bouncing back up today with the S&P. Still oversold from the 10-day moving average, but notice we're just about to get a bearish 1030 cross. Some of you ask about the 1030 cross on the U.S. market update. And by the way, if you haven't gone over, look at it. It's on YouTube on the Elliott Wave Options channel. And the 1030 cross I got from ex-floor traders, ex-market makers. And I've always joked that if you want to know what really goes on the floor, you can't talk to current market makers or current floor traders because they don't tell you. You have to talk to retired guys or ex guys there. And one of the things that they taught me a long time ago was that's what they look at on the floor for signals of short-term trends. A little bit longer term than the 10-day moving average. That's the shortest gauge of what's going on. But the 1030 gives you that short to intermediate range. And then most people look at the 50-day moving average for intermediate to slightly longer trending patterns. So if you get a bearish cross, that normally means that whatever move is occurring to the downside is likely to continue, just like an upward cross means that the upward move is likely to continue. So we had a little whipsawing right here in June where we had a bearish cross, but then immediately got a bullish cross back. And then that held for a while as the market continued up. But if we have this bearish cross, I think that plays into my thesis that the bottom may not be in here yet, and we may see 380 down here on the DIA. I think that is highly likely to occur. Let's look at the IWM. You can imagine that was pretty ugly yesterday. It was. We came down here to this 200 level, thought we might get there, didn't think it was going to happen in 2 trading days, but there we are. Right down to the 200 level on the IWM. It's also bouncing today. It's also oversold, but it's also awfully close to this bearish cross. And remember, we were talking about how not only is that rule of no security in any time frame gets too far away from the 10-day moving average, you also watch the separation between the 10 and the 50. If they get too separated, then that's a signal of being overbought as well, just as being too far from the 10-day moving average does to the upside, and same thing to the downside. But big separation here. So we were overbought on the Russell, way overbought, and down we came. And so we've closed that gap between the 10 and the 50 here. But if we get this bearish cross, then you have to wonder, are we going to stay right here? Are we going back to 190? Is the 190 to 210 range going to come back into play on the IWM? I think that's highly likely. We gave a shot at breaking above 210 and making a new trading range where 210 was the bottom. It's not. So we may come up and test that level before we work our way back down towards that 190 level. So I think that's highly likely in the IWM. So just craziness all over the place. The Qs, as we talked about, same exact thing here. Now the Qs are interesting because they're kind of closer to their lower level than the other markets, but 420 seems to be likely move. We've had this bearish 1030 cross here in the Qs for a week or so now, almost 2 weeks. And so that continued down. If you were following that bearish cross on the Qs, then you probably had a nice trade. Notice a lot of these Elliott wave patterns have relabeled now with these extreme moves. So the algorithm trying to figure out where things go from here as well. That was a nice little zigzag pattern that we had right here in the Qs. And you can see it here. And where did we go? Right down to the 100% extension. As soon as we got to the 100% extension, which we had a 38.2% B wave correction. So the 100% level is the extended level. when you go to 38.2. So we've had that extended move. So maybe we move into a trading range here, maybe a little bit more to the upside. But it does look like 420 is going to be the low there that we want to test on the Qs. If my thesis is correct that perhaps the bottom isn't fully in yet, that we're just getting oversold bounces. So I could be wrong. We'll wait and see how all that plays out. Other markets to look at, the crypto world had a rough day yesterday also with everything going on in the equities market, currencies, bonds. Everything was crazy yesterday. It was a wild day, one of the wildest days I've seen in a while. I love watching the markets. I love seeing what's going on. But when you have a day like yesterday where everything is moving crazy, it's kind of fun and interesting to watch how things play out. So we are getting a little bit of a bounce, but we traded below 50,000 for the first time in quite some time here on Bitcoin. So we got right into this range right in here around 50,000 to 52,000 that we've talked about a few times. That little corridor, it's not a big one, but this small little corridor of potential support here. And you can see that we actually broke down below that yesterday, but back above that little corridor today. We'll see what happens in the Bitcoin world. That could be the bottom there, but it is labeled as a wave 3. So if we bounce up to a wave 4, could we actually have lower lows in Bitcoin? We'll wait and see if this pattern gets relabeled as well. But that wave 3 labeling is a bit worrisome there. And then you go to look at Ethereum, and it had a very rough day. Also, breaking below that 2,500 level that we talked about. That was the next point. If we couldn't hold 3,000, we were going down to 2,500. And we traded through that almost down to 2,000, trading right back at 2,500 right now. Once again, the oversold bounce also labeled in a wave 3. So both these charts on Bitcoin and Ethereum are labeled very similarly. So we'll have to wait and see. If these patterns stay in place, then we should get a little bit more of a bounce, but then perhaps another move lower. But if we are going to get this rally towards the end of the year, which a lot of the crypto people have been saying, that should start pretty darn soon. We're into August now, and cryptos can move quickly, but it would take time for a 5-wave to the downside pattern to play out before moving higher. So we'll keep a close eye on cryptos and see if this 5-wave pattern relabels, but certainly something to be concerned about there. Let's look at the metals. They had a rough day. And that was another reason why, even though it felt like panic yesterday morning, it didn't seem like it was all sort of massive panic. The end of the world was coming because the metals didn't rally. Silver actually went down. You can see we're working our way back down towards the previous 4 here. So once again, the Elliott wave rules. We probably hit 24 on SLV. It's not really getting much of an oversold bounce today. So I think we see 24 in SLV. And then if we look at gold, the GLD performing a little bit better, but no bounce yesterday. With everything that was going on, you would have thought some money would have gone into gold. And I guess you could say some went because it wasn't an ugly move. It wasn't as bad as SLV, but we seem to be working our way back down towards this point of the triangle here. So we could see just a little bit lower level on GLD, but we have this 50-day moving average right here. Maybe that holds. Maybe that's the end of it. But to see an extension on this wave 5 or to be bullish on gold, I think we have to see a move back above 230. So I don't think you want to jump the gun on gold yet, at least on the GLD. A clear sign would be breaking that 230 level. And then I wanted to show you USO because that is going to be our case study consideration for today. We're getting a little bit of a bid back in gold, or excuse me, in oil today. You can see we're trading at 72 now. And with the fact that 75 is such a key level for oil, USO at least, I feel like we probably come back up and test that level again. So we're going to look for a bullish move on USO to bounce back up towards 75. So we'll have Zach come in at the end and show you how to post that into the platform as an idea up to 75. So Zach, it'll be USO moving up to 75. Believe it or not, our AI search, even though the list of bearish possibilities was tremendously long, even with yesterday's sell-off, there weren't enough scores to bring us an actual bearish alert. Got close, but not quite enough. But boy, there's a long list of stocks that could go lower, just not high enough scores to send them out as an alert. But I do think that we have a good chance of moving a little bit higher in USO and at least testing that 75 level. But if we do start to roll over, I think you'll see those bearish scores start to come higher. I don't know that we come all the way back up here into this area. Certainly that 5-wave pattern and the LA wave pattern is gone here on USO as well. So I don't know if we have to worry about 90 in the USO, at least for a while. One comment that came out that I thought was interesting yesterday, and this was with all the stuff economically that the financial gurus were talking about, was the fact that we've set a record for cars on the road and this year. And remember, I've been mentioning how I like to drive at night. I have seen a difference in the number of people in restaurants, but hadn't really seen a decline in the number of cars on the road. And that report kind of came out and backed that up by saying this has been a record year. So we're still driving. The economy isn't broken yet. It does look like we're heading into some sort of a recession. And then who knows what the Fed's going to do if the Fed fund futures are right on the amount of rate cuts. The concern, we actually talked about that and posted that on the weekend U.S. market update that I was referring to on the YouTube channel was too little too late. And it seems like the Fed is going to be late to the party. They usually are. They usually cut too long. They usually raise too late, raise too far. Everything is, they always seem to be behind the curve. And it feels like that they're too late. They raise too long, and they're not cutting soon enough with their concern about inflation. But for a long time they said inflation was transitory, and then it turned out it wasn't. And then they got a little bit aggressive on the rate hikes, and where they could have just tapped the brakes a little bit, they hit the brake pedal pretty hard. And I think we're going to feel that in the economy. It will take a while for the rate cuts to work its way through the economy to get that desired effect of re-energizing the economy. When you cut rates or raise rates, it just feels like they want like this instantaneous gratification, and it doesn't work that way. It takes time for either a rate hike or a rate cut to work its way through the economy and be seen in the data. So when we saw inflation trending down, that could have been their signal that maybe in July they could have cut, but they didn't. And they're just so concerned about repeating the mistakes of the 70s, where they did cut too soon back then, or at least they felt like they cut too soon, and they didn't want to repeat that mistake. But feel like they're kind of late this time around. We'll look at UNG and natural gas getting a little bit of a bounce back up. We've talked about this. The break of 15 was significant. So breaking below that level, who knows where we go on UNG. It's in a wave 3 to the downside. Very difficult to figure out where a wave 3 is going to end. You can see we got a little bit oversold here at the end of July. Bounced back up to the 10-day moving average. Got a little oversold yesterday. Hit the high of the 10-day moving average, or the high of the day hit the 10-day moving average. So where's the bottom going to be in the wave 3? Talked about this a lot from Elliott wave rules. When there's a zigzag pattern within the wave 3, that's what we like to trade in our impulse portfolio, the AI impulse portfolio, because the zigzags help give you an idea where the wave 3 is going to end. Almost everyone in the world of Elliott wave agrees that wave 3 is the strongest wave, but a lot of people tell you to stay away from it because you don't know where the wave 3 is going to end. Zigzags give us that information. However, when we have a wave 3, that's a mono wave like we have in UNG, the absence of a zigzag makes it very difficult to figure out where the wave 3 is going to end. So you just kind of have to watch and see where it goes and look for when we get that test back up. I feel like at some point in time, the wave 4 bounce will come and will likely come up and test that 15 level that acted as such support resistance back the beginning of the year. But now breaking that level so significantly, who knows where we're going to go from here. So I thought we would look at some of the international markets to see how they fared with yesterday's movement here. So let's go start down under with Australia, the EWA for the Aussie market, and you can see is pretty ugly there. Another, I think, tradable opportunity here. Now, one interesting thing about the Australian market is look how close we are to that previous wave 4 now on the lows, getting awfully close there with that wave 5 ending before 100%, back to the previous 4. Once again, we're almost there. So we're a little closer there on the Aussie market, way oversold right now. So certainly could be a tradable bounce. But once again, you can see the bearish cross. Is the bounce going to be enough to get that reversed? We get the 10 to cross back above the 30. We'll have to see. What I think could likely happen is a short-term bounce here in the Aussie market, and then maybe some consolidation. Whether or not we actually hit normally you do actually hit the previous 4. So if you're wondering, it's just getting close enough, or do you actually touch it? Normally, you actually touch that line. Nothing's 100%, so it doesn't necessarily mean every time we're going to do that, but it happens a lot. We'll see if after a short-term bounce here in the Aussie market, if we head back down there. Let's see what our friends up north did in Canada with everything here. You can imagine pretty ugly over there as well. Similar to what we just saw on the EWA, but not quite as close, but in the area of the previous wave 4. So almost the exact same scenario here that I just went through on the EWA is the fact that perhaps the short-term oversold bounce occurs, and then we see if we work our way all the way back down to that previous 4, which I think is likely there as well. Let's look at Germany as a representation of what's going on over in Europe, and that was the end of that. We talked about this triangle. We had a nice triangle here in the EWG, and clear breakout, just a really nice breakout of this triangle that occurred starting the end of last week and then following through the beginning of this week. And we're getting pretty close to where that's about as far as we go from the triangle part of the rules. The mouth of the triangle, you measure the low to the high. That's about the price level that you expect from the point of the triangle when it moves. So we're getting pretty close to that level. Also oversold here in Germany with this separation of the 10-day moving average, and perhaps that ends the, at least for the short term, the move lower in Germany. Now, difference here is their wave 5 extended more than 100%, so we don't need that market to go all the way back down to the previous 4. Just a 61.8% correction is all you're looking for out of the EWG, and that could play out very well. And if we take a look at the fib retracement levels, you'll be able to see that 61.8% level. I'll get it here. Will be where we hit yesterday, and then breaking below that. So we're kind of even past the level that we should have moved. And this is where Elliott's rules of the corrective patterns, flat zigzags and triangles, trump the 5-wave impulse patterns. In other words, he had more belief in those 3 corrective patterns than the overall 5-wave patterns. And so the triangle breakout telling us that we needed to move past that 61.8% once again, as Elliott would have surmised, was the winner. So we went past the 61.8% level. So we're getting to the point where maybe things calm down over in Germany. and we settle in here. Perhaps we find some sideways movement right through this area, right around where the low is now. You can see that consolidation that occurred back in the end of last year and the beginning of this year. So perhaps we just kind of back and fill a little bit here around 29 on the EWG. And then looking at the INDA for India, as you would expect, based on what it's been doing, held in there. Yeah, it got affected, but held in there better than any of the other international markets did. Still below the 50-day moving average, though. And if we're going to see a continuation here on the INDA, we need to get back above that 50-day moving average. Once again, passing 100%. So we're only looking for a 61.8% correction in the INDA as well. Maybe it works its way down, but certainly not quite the volatility over in India that we saw elsewhere around the world. One thing that I think is interesting, we look at a few stocks of interest here before we get to some questions, is Tesla. Tesla, yeah, had a down day, but not as ugly as you might have thought. We did break that 200 level. I thought we were going to come back down to 200. We did. Didn't know that we were going to break it. So we came down almost to the 175 level on the low yesterday and bounced back up. So there's a pretty good channel here on Tesla between 175 and 200. Maybe that's where Tesla trades for a while, kind of in this range here. We got too vertical, you know the rules there. We had that triangle, the flag pattern, which is my favorite when you have a vertical move to the upside, and then you go into consolidating symmetrical triangle. That is my favorite of all breakout patterns, and Tesla came through just like most of them do. So some call that a flag, varying names for it. But when you have a vertical move that consolidates into a symmetrical triangle, that to me is the highest percentage chance of yielding a nice breakout. And Tesla followed through there. So I think we could be looking at a trading range here on Tesla in that 175 to 200 level. Microsoft, you can see we got down, has caught a nice bid so far this morning, but we filled this gap from yesterday. We're still below the 10-day moving average, so maybe we get a little bit more of an upside here in Microsoft, but we're in a wave 3 to the downside as well. We've gotten that bearish 1030 cross, so perhaps we work our way down on Microsoft after this short-term bounce is over, down here to 375 seems like the level that we need to make on Microsoft for it to at least give us a wave 4 bounce. So I'm going to be very interested to see with all of these wave 3s that are newly labeled based on what happened yesterday, what happens after we get this oversold bounce. Does that label the 4? And do we have the wave 5 to the downside? Some of these patterns get relabeled and they're not really 5 wave to the downside patterns. So you can see all this stuff is why I'm saying still be cautious, even though we're getting this bit of an oversold bounce today. Still a lot of caution in mind. I wanted to show you Amazon as well. And just yikes on that with the earnings report and everything else on Amazon. And then this big move down, oversold, little bit of a bid back today, not real significant. 160 seems to be in a very important level on Amazon, and that's kind of where we're trading right now. Can we stay above that level? A little bit of support there, but you could argue that we could come all the way down here to 150, which is pretty much where we were at the open yesterday on the lows of the day. So that's where the range is there, that little channel between 150 and 160 on Amazon is likely where we're going to find a little bit of calming in Amazon. Now, this wave 4 here is at 84%. So that went past the 78.6% level. So that 5 wave pattern is disqualified. So I want to be clear there. Not looking for a wave 5 move to the upside in Amazon. This will go away. This wave 5 will go away. It's a disqualified pattern. So with that, Zach, lots to talk about, but let's get to some questions here before at the end you show them the putting USO in.
Yeah, no, that sounds great. Phenomenal presentation there, Rob. I do just quickly want to say I'm dropping in for the second time the registration link for the AI webinar that we are doing tomorrow. We'll be hosting that with JP Drysdale and Tom Gentile, and it's the launch of the Hub AI signals. So you definitely won't want to miss out on that. And sorry, just trying to make sure I have it entered in here because the character count is exceeded. So let me get to that in a second. We'll start out with a question here from Manuel. CMG second rejection at 55.10 gap.
Yeah, I'm glad you mentioned that AI launch. We've been waiting for that. People have been waiting for that for quite some time. You've got the experts there to tell you from Hub on what's going on with it. So you're going to get all the latest stuff. As you know, Hub gives me the signals, and now it's getting ready to officially launch. For those of you that have been using the Hub software, et cetera, I'm sure you're excited about that. So make sure you attend that. Zach gets the link in there for you, especially with what's going on now. One of the comments that I made was the two most recent signals that we had were on CB Chubb, which is insurance, and that's feeling a little bit of hurt with the interest rates, but that'll calm down a bit. And then Philip Morris, which has been basically outperforming the market. Those are both defensive names, and those were the only two signals that we had in several days. And it was almost like somehow the AI knew that, hey, we need to be cautious here. We weren't getting any high beta name results. So it's amazing how the AI works. And so you want to attend that for sure. All right. So on Chipotle, yeah, we came back up and tested 55, and it got turned back away from 55. They didn't have their stellar earnings report this quarter like they have in the past, and so the stock got hurt. And now we're looking for where will it find a bit of support, and it seems like right here would be a logical spot because it's the 61.8% fib retracement level. So that could be a place where we at least bounce back up and test 55 if we get this oversold bounce test that I've been talking about. But I also have to look at this area down here around 45 as the point, somewhere in this range, 45 to 47 or so. Right in there is where the support resistance was from the beginning of the year. So maybe we get a little bit of that oversold bounce, but we have tapped the 10-day moving average on the high. So that one's kind of already done a little bit of its oversold bounce stuff. So perhaps we don't make it back to 55. Maybe we do, but I don't think we go above 55. So anyone that's looking for a long entry on Chipotle, you want to wait till it gets above 55. Don't go long Chipotle till it's above 55. And then if we do work our way down here from the 10-day moving average, I think maybe, even though that's my favorite of all fib levels, the 61.8, we could go a touch lower, but that could hold. And maybe we just kind of bounce around a little bit here. But if we do start to bounce up in a wave 5, once again, the long entry is once we trade above 55, not before. So somewhere in this range here is where I think Chipotle is going to be until now. If it were to break 45, then it's almost a Katie bar the door, Zach, because that move up.
It's been too long.
Yeah. Well, gosh, we kind of had one in the markets yesterday, didn't we? At the open, that was pretty much a Katie bar the door.
Careful
But
what you wish
we could
for.
see, yeah, we could see 35 here on Chipotle. And these always feel so much worse after a big split like they had when you get these outsized moves. So kind of bad timing on their split. But that's if 45 doesn't hold. And there's we broke 45, then it gets pretty ugly, but we got to get there first. So next.
Very well. Thanks, Rob. Let's go over to Uber for Will.
Oh yeah, Uber was a surprise. reported better numbers than a lot of people thought, but bad timing, right? Bad timing in the markets to be coming out. Just like you can't do anything right now. You have to almost the only thing that's really been moving up are companies that were subjects of acquisitions. So 55 here is where we are with Uber. It is in a wave 3 to the downside, which is certainly concerning. It looks like we have a bit of a long-winded zigzag here. So if we take a look and see where that C wave extension, right around that 61.8% fib extension to the upside, and note that we're right at the 100% extension down here. That's why we keep looking at these. That's why we show you the LA wave, the zigzags, all this over and over and over again. So maybe that's where Uber finds a bit of a bottom. It needs to fill its gap. It needs to move up to the 10-day moving average. So looks like a stock that could give a little bit of a short-term bounce here with the driving numbers, etc. People still on the move, so to speak. But if it breaks that 100% level, then 161.8, as you can see, is down here below 50. So we'll watch to see if we can stay pegged somewhere around this 58 level on Uber. I do feel like we could get a little short-term bounce out of it, and then we'll have to see. We're just going to have to re-examine all the charts once we get this oversold bounce over the next few days.
Thanks, Rob. Next up, we'll go over to AEG for Mikhail.
All righty, AEG. Aegon. Also kind of feeling the wrath of the interest rate stuff going on. And we're at a level here, right at a 50% correction. It's oversold. It's in a massive area of support. So I like this one for a bit of a bounce here. And we could head back up towards that level there of the 10-day moving average. If you want anything more than just a quick oversold bounce, we've got to break above this about 625 level here on Aegon. If we could get back above that, then maybe we have something longer term, like perhaps the wave 5 moving. But for now, if it doesn't bounce here, I don't know what will, because it's such massive support. So I like this one for a short-term bounce as well. So both those last two, Uber and Aegon here, look ripe for shorter-term bounces to me.
Agreed. Good spots there. Second symbol we're going to go over to is NAT, N-A-T.
All right. Even with all the stuff that I gave you about driving and everything else, still the tankers, oil, everything else still heading lower, which is a bit of a surprise. I'm not sure where we could find a bottom here. You can see that we did have not only a zigzag here, but a complex zigzag in the C wave, because here's the big one. There's the big, and it actually right at that 78.6%, really close to being disqualified. But that gives you the 100% extension right where we've broken in yesterday and today's trade. And then within that, we also had this zigzag pattern right here. So there's the complex C wave. And you can see that looking at the 100% here, we already passed that. And we're also at the 161.8% level there. So perhaps we are ending the wave 3 lower here on NAT with both of these zigzags in areas that are showing you that this is probably a point where we find a bit of a bottom. But once again, it's in a wave 3, and maybe we bounce back up from here. But certainly a good illustration of the two zigzags working in concert with each other. And a complex wave, if you're not familiar with LA wave terminology, just means a wave within a wave or a pattern within a pattern. And that's why the fact that we have this zigzag within the C wave makes it a complex pattern rather than you get these moves like the A was just straight down and then the B was straight up. Those are called mono waves, meaning that there's no other pattern within the waves. It's just kind of a march, whether it's in a 45-degree angle or something similar. Those are mono waves. But when this occurs, it's a complex wave. Okay, so
Awesome, Rob. I love when a chart provides the opportunity for you to so clearly illustrate the educational side of understanding these concepts in further depth. We'll look at CAVA, C-A-V-A for Greg.
Yeah, we haven't looked at that one in a little while. So bring that one up and see if we can get a little more data here. Well, just hasn't been around here long enough to give us an Elliott wave pattern. That's what it's telling you there. It doesn't have enough days in there. I have mine set at 377 data points to label the Elliott wave through the algorithm. So just looking from support resistance here, you have to be impressed with the move back up today. The key would be, can we close above that 50-day moving average? We're trading right above it now. And if we can, you might have something going here. So certainly a much better looking pattern than a lot of the rest of the things that we've seen. A better signal, I think, would be first step, let's close above that 50-day moving average, but let's try to get above 85 here. And if we can get above that level, then maybe we have something working here back to the upside. So certainly a lot more of a bullish look to this chart than most of the other ones that we've looked at, save the short-term oversold bounce scenario.
Very well. Thanks, Rob. Next up, we have a second question from Greg. I would like to start a position in spot. Any suggestions?
Let's see what it looks like. Just so much craziness going on right now, but that one held in pretty well. Also, it did open lower, but has also rebounded right back to the upside. The concern here is this wave 5 done? We only went to the 23.6% wave 4 correction. Elliot wouldn't like that. If he was here, he would be looking at this as more of just one big, huge impulsive move. But acknowledging that 23.6 is a fib level and placed a lot of emphasis on Fibonacci levels and their importance from support and resistance, that's in the algorithm. So it does look like a 5-wave pattern to the upside, but it would not be one of Elliott's favorites. He wouldn't put a whole lot of weight in that. So my point here is that wave 5 done and we're coming back to the previous 4? Maybe not. We are sitting on a pretty good level of support. At least we were at the open yesterday on the low right at 300, and that did hold there, and it also filled this gap, which it needed to do. So I would say that from the majority of the charts we looked at, this is right up there with one that you could take a shot at for a long position, certainly outperforming most of the market, even above the 10-day moving average, which is pretty impressive if it can close there above the 10-day moving average. So tested that level that it needed to hold at 300 on the open yesterday. Nice rebound back to the upside. I think you could, if you're aggressive, go ahead and take a long shot now. If you're slightly more conservative, then let's see if we can close above the 10-day moving average today and start to follow that through tomorrow. And then that would be a little more of a conservative, because you know the rules. One day doesn't really mean anything. You need that second day, the follow through or confirmation day. But everybody has different risk tolerances. So I usually try to talk on entries and exits, et cetera, on aggressive and conservative, mostly on entries. You know your own risk tolerances. And so, yeah, if it looks like we're going to close above that 10-day moving average, the aggressive move is go ahead and take a shot at it in case this bounce continues in the market for a few days. But more conservative, make sure it closes above the 10-day moving average, see what's happening tomorrow if it's going to follow it through. But yeah, I like that one. If you're looking for a place to put on a position, you've got a good one there. All right, so Zach, we only have 5 minutes left, so let's bring you in real quickly to go through and show them how to post that USO trade, and we'll let everybody get back to their trading day.
Yeah, that sounds like a great plan. It's been a very informal presentation, especially a very exciting week so far. So I think everyone, including myself and yourself, are ready to get back to the market. So let's go ahead and post an idea, as he said. Once you log into the Hub dashboard with your credentials, this is where you'll be redirected to post an idea. We go to this little light bulb right here. We can go to New Idea, and that gives us the option to create an idea or create a post. And Rob, did you say this was going to be an official idea?
It is, yeah.
All right, real quickly, just to differentiate between the two, a official idea is if you are ready to actually take this trade in real time, as if you're paper trading with a brokerage that offered that method. Whereas a post is if you were at a draft idea. We'd say it's all the criteria. Most of the criteria is fulfilled for the idea, but there's some things that you need to see play out before you're ready to fully execute the position. So you'll leave it as a post for reference until you see that criteria met. But as Rob said, this one's going to be an actual official idea. And I remember we're going up to 75, and we will just keep it nice and simple to be mindful of everyone's time during this session. So as you can see there, I just entered in the symbol, my target price, and what was the time frame on that there, Rob?
Let's do 2 months.
2 months. So as you can see, we have these set intervals of time here, these fixed intervals rather. If you need something more specific, you can go down to the very exact day that you'd like. And Rob said 2 months. I always like to go to the first trading day. So today is what, the 6th. So we'll go to the 7th, and this will be to be continued once we make it pretty after this session. But after this, it'll be posted very shortly, and you will be able to come in and interact, vote, agree, disagree, and share your thoughts. So we encourage you to do that for all of the ideas that you see throughout the platform, and just interact with the community. There's many ways to benefit and learn from other people's ideas, or just be able to spark creativity in sectors that you might have not been looking at previously, and so on and so forth. So again, don't forget to register for that event. I'll put that registration link in the chat one more time. That is going to be tomorrow at 7:30 Eastern time, and it's going to be with JP Drysdale and Tom Gentile. They are going to be doing the Hub AI launch, Hub AI Signals launch webinar, rather. So definitely something you won't want to miss. Lots of valuable content going to be discussed overall on the functionality of the platform and what you can expect. And lastly, make sure to at least register for the event, even if you can't attend live, because you will receive a recording after the event is over, even if you didn't attend live. So over to you, Rob.
Yeah, thanks for highlighting that. I hope everybody attends. It's certainly going to be quite interesting. I'm looking forward to it myself. Thanks as always for spending some of your trading day with us. I hope you found it informative, and I look forward to talking again soon. Take care, everybody.